So there's a market worth over $100 trillion that affects your mortgage rate, your car loans, and even your job if you have one. I don't. I'm talking to a camera right now. It affects your stock portfolio and even the price of gold. And the thing is that most people don't really know how this market works. And no, it's not the real estate market or the stock market. Well, it's in the title of this video. It's the market that decides what the value of money actually is. It's the bond market.
All my life I was looking for a sign. Wasn't sure where to find a peace of mind.
So that was my attempt at trying to make the bond market look sexy, because it sounds boring, right? Like, what is a bond? My grandparents had some bonds. Bonds are, what are they? What is a bond? James Bond is the only bond I know. But right now, something very important is happening to it. The 30-year Treasury bonds yield went up to 5.2%. If that didn't sound like English to you, I'll explain all of that. Just know that this yield hasn't been this high since 2007. And we all know what happened then.
No, he has no idea how bad it is out there. He has no idea.
Yields being here at the same level they were right before the Great Recession does not mean that they caused it. But it does mean that we're back in a financial environment that all 12 of you watching have probably never invested through before. So here's the question I want to answer today. Who decided that? How does this bond market that affects everything actually work? It wasn't the Congress. It wasn't the Fed. It certainly wasn't this guy. So who was it? How does someone decide what the cost of borrowing actually is? And who are these people? So today I want to follow the story of one bond, so we get a full understanding of how this market actually works. We're going to start at all the way from the Treasury and go all the way down to us, the little guppies that could buy it once it's been traded over a dozen times. Okay, so the first question is, what is a bond? Imagine you're starting a business. You have all the drive in the world and you have a great idea, but you have no starting capital. So you go to someone who does. And they say, sure, you can have some money, but when you return it, I want a little bit on top. They want interest, because that's the cost of borrowing money, right? Because $1 today is worth more than $1 in 5, 10, 20, 30 years from now, right? There's an opportunity cost. They could have invested into another business or the S&P 500 or a shiny metal rock. Now, people borrow money, companies borrow money, but governments also borrow money. And when they do it, they issue something called a bond. That makes them the issuer, the borrower, and the investor is the lender. So a bond is basically an IOU, but it can be traded. And we'll get to that in a couple of minutes. The US government is always spending money, right? They're spending on infrastructure, on healthcare, on offense. Oh, sorry, I mean defense. It spends way more than it collects in taxes. We know this by this massive looming debt clock that is about to hit $40 trillion any day now. And the difference between what it collects and what it needs is called the deficit. And this is where bonds come in. Now, the part of the government that sells these bonds is called the Treasury. So the Treasury literally sells government debt. They capture that debt and put it into a little piece of paper called Treasury notes, Treasury bills, or Treasury bonds. Treasury bills mature in a year or less. Treasury notes run from 2 to 10 years, and Treasury bonds are the long ones, 20 and 30 years. They all have the same mechanism, just different dates. Basically, investors give the money today, and they give investors back the money on a later date with interest. Okay, so let's get to the actual example. The government wants to go help the world somewhere, and they need $100 billion. They call up the Treasury and say, hey guys, we need $100 billion. The Treasury looks around and says, well, we don't have any money. But you know what we do have is debt. We could issue that debt and create bonds. And that's exactly what they do. It announces an auction. And this is where our cast of characters show up. You've got the Treasury, obviously. They're creating and selling the debt. You've got large investors, pension funds, insurance companies, banks, hedge funds, foreign governments, central banks. And you've got a special group called the primary dealers. There's currently 26 of them. And why they're special, we're about to find out. I'm talking about JP Morgan, Goldman Sachs, Citi, Morgan Stanley, Barclays, Bank of America, TD Securities. These primary dealers kind of have a strange job. They're expected to show up every single time the Treasury does an auction, and they're expected to bid. So think of these guys as the top, the wholesalers. This is the big fish, the whales coming in, and they are buying straight from the top of the pyramid. The Treasury auction functions like a Dutch auction, which means that it starts at the lowest rate. So let's say, for example, Goldman comes in and says, okay, I'll buy $20 billion worth of your bonds for an interest rate of 4.8%. They start to bid off pretty low. And slowly, as the bidding continues, at the very end, let's say Citi comes in and buys it at 5.2%. What happens is that all the other auctioneers, all the other people who were buying, Citibank, Goldman, TD, all those guys get the highest rate that Citi got at the very end. So if the Treasury is selling a mountain of debt and investors are desperate to own it, they'll sell it at a lower yield. Well, and a yield, by the way, just think of yield as ROI. Yield is exactly what they will get in return, interest on their payment. But if investors are hesitant, then the Treasury has to accept higher and higher yields until all of the bonds are scooped up. So the Treasury decides how much debt it's going to sell, and the primary dealers, the market, gets to decide what they're going to pay for it and how much interest they're going to receive for it. Real quick, if you've learned something so far, I would love it if you could just hit like and subscribe real quick. It helps me out a lot. There's literally only a couple dozen of you guys, and any little bit helps. Appreciate you. Okay, so the auction ends. The government gets its money, the investors get their bonds, and now our bond leaves what's called the primary market and enters the secondary market, which is where most bond trading actually happens. So when you come into the secondary market and you buy the SGov, for example, a bond from the government, it's actually not coming from the government. It's already been passed around a couple of times through other much larger investors. And the single most important rule of the bond market is this: bond yields and bond prices move in opposite directions. So if the yield is high, then the price of the bond is actually much lower. Let's say you own a bond that pays you $5 a year, and that bond is currently worth $100. $5 on a $100 investment is 5%. Now imagine new bonds come out offering better returns. Well, nobody wants to pay you the full $100 for your old bond anymore, right? The new buyer's like, why would I pay you the full price when the new stuff pays more? So your bond's price falls to $90. It still pays the same $5, but $5 on a $90 purchase is a better return than $5 on 100. So when you hear that the 30-year yield went up, like it just did, to 5.2%, what that actually means is that the Treasury bonds went down in value, and investors want to be compensated more to own them. And why would they want to be compensated more? Well, there's a variety of reasons. Maybe they expect inflation to stay higher. Maybe they think the Fed keeps rates higher for longer. Maybe the government is issuing so much debt that buyers want a better deal to absorb it. Or maybe they just want a bigger term premium. Because 30 years is a very long time for something to go very wrong. Before we get to how this actually affects me and you, our little bond has one more market to go into. It enters something called the repo market. This is the real plumbing of the financial institution here. This is the nitty-gritty. If you understand this, then you actually understand how most banks and how money works. Say a bank owns $100 million of treasury bonds, but it needs cash overnight. So the bank goes to another bank and says, hey, hold these treasuries and give me some cash. I'll pay you a little interest just to hold my treasuries, right? And just give me the cash so I can be fine overnight and be ready for tomorrow's market open. Banks do this all day, every day, and that is how they stay so liquid. And this is one of the reasons why bonds are so important. They're not just investments and a safe place to put your cash, they're also true liquidity. They're also collateral. So let's take a look at the journey. The bond starts as a way for the government to borrow. Then it becomes an investment, and then it becomes something that can be traded. Finally, it becomes collateral that helps the rest of the financial system borrow and lend. The bond market is a circulatory system of the entire financial system. If you think of it as the human body, bonds are the individual blood cells going through. The Fed, well, in my opinion, would be a tumor, but hey, I'm no doctor. Okay, so now you understand the overall machine. We've been from the very top to the very bottom. But what's with the different years? Why do we have the 30-year treasury, 10 and 2? Honestly, the 10-year is arguably the most important out of the three. It is essentially what corporations and also mortgage interest rates are keyed off of. And the 2-year is essentially the market telling you what they think inflation is going to be. If they think inflation is going to be higher, well, they want more money now, right, to beat inflation. The 2-year is essentially what they think the Fed is going to do. If the Fed is going to raise interest rates, well, they want a higher interest rate on their bonds for the next 2 years, right? But the real story here is that the pressure has moved all the way down to the long side of the curve, to the 30-year treasuries. Long-term money now costs way more than short-term money. And that new price of money doesn't just stay isolated in the bond market. This is tying into the very beginning of this video where I said it affects mortgages, jobs, stock market, crypto market, because think of it like this. The 10-year is the benchmark for all mortgages. So if the 10-year yield goes up, then mortgages will also go up. It'll be more expensive to buy a home, or at least more expensive to borrow money to buy a home. Then companies, it also becomes more expensive for them to borrow money. So there's going to be more layoffs and probably a lot less hires. And finally, big investors are looking at the stock market that is close to all-time highs and saying, why would I take a massive risk on that if I could just put my money into this very, very safe asset that is promising me 5.2%? Okay, so now we get to gold, because it does affect the gold price a lot. Gold and treasury bonds are essentially the same thing in the financial market's eyes. Very safe assets that you can hold for decades and nothing will happen to them, right? But if all of a sudden the bond market is looking sexier like it did in the beginning of this video, well, why would I have this shiny metal rock that doesn't do anything? I'm gonna go move all my cash, all my capital over to the bond market because now it's sexy. It's giving me 5.2%. I could just lock it up, right? That's a pretty good return. Gold doesn't do anything. It just sits there looking pretty in your hand. I have a whole video on this relationship explaining gold and the bond market. If you want to have more info on that, click right here. But the relationship isn't as simple as bond yields go up, gold price goes down. So tying this all together, the government needs money, so they go and they sell their debt at an auction. The primary dealers are at that auction waiting and they all bid. At the end, they all get the same yield, the highest yield that the treasury is willing to offer. That is the market deciding what the yield's actually going to be. They, the wholesalers, the primary dealers, then go into the secondary market and sell to other banks or to other hedge funds or to everyone else who wants this very, very trustworthy piece of collateral. There, it enters the repo market and becomes the easiest piece of collateral to move literally overnight. And the yield on that bond becomes the thing that affects our mortgages, potential job prospects, our car loans, the price of stocks and gold and almost everything. And that's why the 30-year treasury yield being so expensive, so high up at 5.2%, the highest it's been since 2007, actually matters. Because it doesn't, I should probably stop slamming on the desk because it's shaking the camera. But that's why it actually matters, because for the first time in a long time since quantitative easing was invented, we have expensive money again. So what is that actually going to mean for all of our investments. It probably means some headwinds our way. So yes, I have tons of gold. Well, not tons, stacking the ounces, but it also means that I'm stacking up some cash as well. I usually don't like to have cash, but the last time we were in this position, it wasn't really good for assets. The best assets, the assets like gold and silver, and potentially now even Bitcoin, are the ones that are going to bounce back fast and first. So, like I always say, stack the gold, get out of debt, and get out of the system, and I'll see you in the next one.